All right, everything looking good. Let's go ahead and get this party started. If somebody could just let me know in the comments down there or in the chat that everything's coming through loud and clear, would greatly appreciate it as always. In the meantime, let's go ahead and get started. Welcome back to the channel, Crypto Trend Trader, with our midweek market update. It is 8 p.m. Eastern Standard Time on September 7th, 2022. And of course, as always, this is not financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly. I appreciate you, Jay Hoff. Good to see you. All right, so let's go ahead and jump right in and take a look. Obviously, we saw the same relationship holding up, basically textbook at this point in time, where we see TNX and DXY trading in tandem, and then essentially everything else sort of trading reverse. So no secret that a little weakness in the TNX after quite a big pump over the last couple of weeks. And again, a little weakness in the DXY after just putting in a new cycle high. TNX slightly weaker, didn't quite put in the cycle high yet, but not crazy to think that we could see a little pullback or cool down or even just a little bit of a chop while essentially, assets go a little bit higher. Now, is that going to change our macro? No, we're nowhere near that. Obviously, we saw some big moves in the last couple of days and violated some key areas. And it's sort of funny here. We always look at gold and crypto, on these two windows, and we always have TNX and DXY here as well. And when we look at these charts right now, just in the broad sense, we can see that these are trading almost exactly the same. Again, the difference being the DXY is slightly stronger, so we're putting in a higher high right here, as where TNX is still slightly off of the highs. And then here on the gold chart, we rolled over into a bear market again, below the 200 exponential and simple on the daily. And at that point in time, we backtested and then just rolled over. Same thing on Bitcoin, backtested and then rolled over. And now we're essentially putting in the same attempt at a double bottom right now. So very interesting how close some of these assets are trading. So a lot of the gold people out there always hate on Bitcoin. A lot of the Bitcoin people out there hate on gold. But the truth is, right now, neither one is looking particularly amazing. And if you're going by, yearly performance, like just this year, or, current performance in the market, you got to give it to gold, because Bitcoin is down substantially from the highs, and gold is, down a little bit, but nothing even close to the drawdown we see in crypto. So very interesting. Obviously, we've been watching the same correlation, and you could essentially substitute in risk assets for Bitcoin, and you basically have the same scenario. The big difference being is that, when Bitcoin rallied up here, when crypto rallied up, I'd had a very, very weak rally. So now when it sold back off, it's hanging out at the lows. And we see the difference between something like Ethereum that is well off of the lows in comparison. Switching over to the Ethereum daily chart, we see we had that same breakdown, confirmation of the bear market. And then on the run up for Ethereum, we ran all the way back up to retest the 200 exponential and simple. Now we fell slightly short, but this looks much closer to what, your typical stocks did. So arguably Ethereum is performing much better than crypto is, but really crypto is just performing horribly, and Ethereum is just kind of performing the same way as the rest of the stock market is, as opposed to the cryptos which are drastically underperforming. So we see some interesting dynamics, obviously some fundamentals leading up to the strength in Ethereum, but we do see that reflected as well on a couple of our other assets in the crypto space also. Now the majority of them are weak, and we see that with crypto market cap and Bitcoin dominance chart, but there's still a couple strong or better performers in the space. So we're going to take a look at essentially what's going on here, walk through everything, talk about oil and potential hedge to just straight up going for oil. If you wanted a little less of the volatility to the up and downside, just a correlation we have. So let's go ahead and take a look at what we got going on here. Obviously, nothing has changed for the broader sense. I mean, the TNX is still in a very strong uptrend on the daily. We're essentially threatening the cycle highs, which obviously we're not going to sit here and call for a double top. Makes more sense. It seems more realistic, historically speaking. As long as we're continuing to make higher highs, we're likely to continue doing so. And obviously we have a bullish fundamental catalyst on top of all of the technicals as well. We know obviously daily, weekly, and monthly are all relatively strong. If we switch over to the 2-10-year spread here, we can see again we have essentially taken out the area from 2018, the key area we've been watching, and we're consolidating above that as well. So we see the 210 likely going to consolidate at or around these highs right here until we see that Fed funds rate, that next Fed meeting. But we can see essentially the 10-year is in orange here, and when the gap is big, we see the most orange. When the gap is tight, they're basically on top of each other. And we can see, even though technically the 10-year here in orange, we're essentially at that level. We saw that on our previous chart. But at this point in time, the 2-year has shot up substantially higher than the 2-year peak back here. So part of the reason we look at these different time frames, we look at these different charts, is to see when one is diverging from another. So it appears as of now, the 2-year is completely disrespecting the previous high from 2018 and likely to go higher, which we could see obviously the previous level before that was at 2007 peak, the double top at about 5%. As where we see with the 10-year, it's still hanging on and respecting that level for now. But again, when we see the Fed funds rate essentially get a hike of 25 basis points or more, that confirms, this same chart basically on the Fed funds rate and our break of that previous level in 2018. And again, puts us in line for that 5% move. So, a move up to 5%. So that is what I'm expecting. It is interesting to see that the 2-year is obviously going ahead and moving on without the 10-year and the Fed funds rate, for now at least. So if we go over to oil here, so this is the oil futures chart for U.S. oil, WTI crude. And then I just went ahead and overlaid in the background here another chart, just to kind of see the difference and how they've been acting. And you can see that while they're slightly different, obviously oil itself has a little bit more of the volatility. We see like a big spike through here that does not correspond with what's going on through here. So you miss out on some of the upwards volatility. Here you capture the majority of it. And then, on some of the downdrafts as well, we see the same thing. So it's a little muted version of the same thing. And it, obviously is going to make sense here in a moment when we look at it. But overall, following the same trend to the upside. Now, it is important to note there was 2 times where these two diverged from each other pretty heavily. The first was during the Rona dump here. This bottomed out substantially sooner. And then obviously we saw, physical contracts, futures go much lower to basically like that push down to 0. And then if we go over here, we see, they trade in tandem almost perfectly the majority of the time. But again, some of the upside volatility and downside volatility muted. And then recently we actually saw something different starting to happen here. Rather than trading, as specifically as they have been, or like as correlated as they have been, we saw essentially a divergence right here. When oil came down to the 200 exponential and simple, it melted straight through it, and then it's back testing the 200 exponential and simple. Like in a similar way, if we were looking at just our orange plot right here, this basically bounced the 200 exponential and simple and then put in a lower high. And, if you're looking like curiously as to what this is, haven't figured it out already, it's just the XLE. So it's just, an index of energy. So instead of looking at just the raw asset, you're looking at, basically a basket of associated or related, commodities. So, you have actual companies that have slightly different effects than, say, just the input, of crude itself. Obviously, they have some other energy in there as well. So the idea being that if you were just straight up speculating on crude oil right now, and we see crude oil is basically falling through support, as where if we look at XLE, energy in general, and you'll see this throughout like the space, not just this specific fund, but essentially it's bouncing the 200 exponential and simple and stayed much, much stronger. So we see the divergence happen when they came down to the 200 exponential and simple right here. And part of that is because nat gas is so much stronger. We're also seeing, there's a lot of utility producers that use nuclear, and nuclear has stayed stronger. Obviously, uranium related products have seen a little bump up with, some of the news and, essentially the bounce off the 200s as well. So whether you want to look at it as the news are telling you this, the charts are telling you that, or they're both agreeing, it doesn't really matter. The fact of the matter is is right now oil is diverging. So it is kind of funny. Obviously, I'm not one for like big conspiracy theories or whatever, but oftentimes, obviously, conspiracies are proven right over time. But we're seeing now essentially that the Saudis and some of the oil cartel are coming out and basically saying, hey, we know there's like manipulation going on in the oil market, and we don't like it because we're seeing mass demand, and oil prices should be staying high or going higher, and that's not what's happening here. So is this some actual manipulation taking place, and that's why oil's breaking down here? Is it just a fluke? Is it because there's people speculating on futures that aren't necessarily interested in buying actual order? So it creates the illusion of fake demand, or creates the illusion of manipulation, etc. I guess we'll never know, or maybe we will. But regardless, we do see that there's definitely something going on here where oil is diverging from energy in general. So in my opinion, right now, sure, you might miss out on a couple of the big spikes to the upside, or dodge a spike to the downside. But in my opinion, something like XLE is much more of a, safe or roundabout bet than speculating like straight up on like future contracts for oil or whatever. Now, obviously, none of this financial advice. I'm not your financial advisor. These markets are extremely volatile. Please, research, trade responsibly. But, oftentimes, especially after a pretty epic run like this, a very strong bull market, all the way up here, and now it looks like we're rolling over. It looks like we're confirming into a bear market on oil, or very, very close to the 200 simple rolling over. So at this point in time, it seems like downside is much more probable. So in order to hedge, your portfolio, or in order to, make more intelligent moves, even if you're not considering it a necessary hedge, sometimes taking away a little bit of that volatility is key after such a massive run up. Because, we could have a massive run to the upside. And obviously, if we're going to have a pullback, if we're going to stay invested because we're still bullish on the space, but we don't want to have to worry about it running away on us, we can move to something that has, a slightly less relationship to the market. So obviously, we're seeking alpha oftentimes in the market, especially when it's bullish. But when you're, potentially looking at that downside potential, you don't want to exacerbate your losses the same way you exacerbate your gains. So that's when we kind of pare back away from some of the more risky or some of the more volatile areas. So we still get exposure to the space, but we have a little less exposure to the overall volatility in that space, or like the big aggressive spikes, but still capture the overall direction. So that is our energy / oil chart. And you know what? Actually, while we're here, I'm going to just switch this up just a little bit here. Okay, so don't worry about that box. I honestly don't even remember half the time what these drawings are. So what we're going to focus on here is this little area right here. So we talked about the potential of bouncing the bottom channel here on oil and the move back up to the top of the range. And obviously the opposite happened. Now, of course, most of our trade setups work out beautifully, but sometimes they don't. And it's important to talk about when they don't, and why we went the direction we did, etc. So it was pretty obvious here as we came down to the support level multiple times that we were going to lose this area. And we talked about this obviously ahead of time. The key here was basically getting back above the 200 exponential and simple. And after that failed, it looked like we were going to retest the lows. And likely when you get a double bottom like this, after a pathetic bounce and underperformance, after breaking out of this channel, a lot of stuff is telling you, hey, this is looking weak right now. It probably is going to break down from key support. So, obviously that was our key support we were watching, which was the bottom of this little move back down here. So we were expecting at least to move up to the 382. It underperformed. That was in line with the break of the descending channel right here. And again, we underperformed the measure move. So we could see here there's a lot of weakness in this. And then, of course, as soon as it comes down and retests the lows, we don't have to just sit around and wait to get stopped out. Sometimes, you'll pull the trigger and get out of a trade in advance, and then it will turn around and you'll think, oh man, what was I thinking? Most of the time, though, when you see something and the market gives you new data and it doesn't look good, pulling the trigger slightly early, more often than not, in my experience, works out for the better. So now we see obviously a clear breakdown from our descending channel here. And, realistically, we have some ascending supports here, the bottom of the ascending broadening wedge. That was our target, has been our target, is still our target. At that point in time, when we get down there, we would expect a potential bounce from that level. But we're basically back inside this descending channel. We've broken down from this descending channel, and potentially are targeting. Well, I mean, at this point in time, it's everyone is targeting high 70s for our next level. 70s, mid to high 70s, obviously is a big deal. As we're losing some of our key support levels. Now we would expect to find support somewhere in this region. Obviously we have our peak from back here, which lines up at about that 75 level, and then this peak from right here is what we're breaking down from. So there is quite a bit of price action took place in this region. We would expect at least some kind of temporary support, but it is possible that we come all the way back down to the bottom of this ascending broadening wedge, and then we actually lose the wedge. Now typically we'll see some kind of underperforming bounce, pull back down to like mid 70s, a back test of high 70s to low 80s, and then a potential rejection to go lower. But again, it is important to remember we're still massively bullish on oil, just not right at this second. And again, we want to switch out to longer time frames and just talk about this briefly. So obviously quite a bit has happened recently, but if we just turn off our drawing tools and pay attention. Matter of fact, I want to talk about this really quick before we do turn them off. We have this pretty clear descending resistance from the all-time high in oil right here, and then obviously pretty clear resistance around 2013, 2014. We peaked out again at that same area in 2018, and then we broke above that area here in 2021. And that to me looks like, essentially some kind of double bottom, Eve Adam double bottom. You could call it whatever you want. Maybe I'm getting too creative with it. Doesn't matter. The fact of the matter was we had a descending resistance or a neckline. We had essentially a double bottom pattern, and then when we broke through that neckline, we came back tested it, and then went parabolic almost back to new all-time highs. So we know the market is respecting what's taking place right here. So obviously we want to keep paying attention to it. And then here we saw obviously the 200 exponential cross above the 200 simple. That is a huge bullish momentum signal saying that not only are we now in a bull market above the 200s, but now the 200 exponential is on top of the 200 simple. And since then we went absolutely parabolic. Now it's looking like, essentially a double top or a blow off top or something along that line. And we're coming back down here. So what would we expect? A potential, retest of the 200 exponential, which now is at 71. It is possible we get down here to like 63 or 64. But we don't want to push our luck on this because we're actually super bullish on what's taking place right here. We just got out, obviously, before this, disgusting pullback, which obviously in hindsight, you look like a genius. We got out essentially right around 114. And since then, oil came down 30%. And a lot of that move was pretty quickly. So if we decide we want to get back into oil at any point right now, we're basically getting, 33% more. Well, we dodged 33% loss essentially. So we're getting, a nice chunk more for the same price because it's come down so much. So that is always one nice thing about just dodging downside. And then, obviously if we go back to new all-time highs or something like that, puts us in a very advantageous position as well. So do we come down here lower? Do we bounce this area right here? Do we hit the 200 exponential or 200 simple? We don't know. Obviously, we see a bunch of weakness in the chart, quite a bit of momentum. The 821 weekly cross has taken place as we've been discussing. And typically when we see that cross take place, we see pretty aggressive moves down afterwards. The majority of the time, even when we were basically chopping sideways through here, the majority of the time when we got the 821 cross, we backtested the 200 exponential and simple. So it seems likely that we're coming down to at least a 200 exponential. I would expect 71 or right around 70 to be a very, very strong support. Now, how does this all line up with fundamentals and all that good stuff? I mean, we'll obviously have to see in time. But right now, still looks very bullish. Here's on the monthly now. Again, same thing. We topped out. We broke down, backtested, put in essentially some sort of double bottom pattern. And then when we broke through that, depending on if you're looking at a descending slope neckline or if you're looking at just a flat neckline, it's a pretty clear like W pattern. And then when we broke through it, we blow off top. And now we're basically coming back down here. Again, the majority of the time when we backtested, we either came to 200 exponential or simple, or we backtested down to or below the 21. What we don't want to see happen on the monthly is we don't want to lose the 21, come down here lower, and then see the 821 cross bearish. That's the last thing we want to see. But for right now, it looks to me like we broke through some key resistance. We're backtesting that resistance, that support. And again, that 73, that peak from right here, the 200 simple on the monthly, all looks like a pretty compelling case for it to come down to. Hard sell signal left the bullish control zone. Stochs are powerfully angled to the downside. And then obviously we see multiple red histograms in a row coming back down, still well above the slope line, well above the zero line. Slope is still blue. So again, this chart still looks pretty bullish to me. I'm sorry. We're above the 200s. Everything's postured correctly. But it looks like we're going through at least like a short to midterm, downtrend. So could oil essentially chop around and just kind of slowly work its way down to like the mid 70s, low 70s even over the next 2 months, 6 months, a year? Yeah, definitely could. It definitely could. Afterwards, though, the reaction we get when we do come down to 73, maybe it's a front run and it's super bullish. Maybe it, overshoots and we come down to 65. If we find support, if we end up consolidating for any amount of weeks, months, arguably years above this level, I fully expect oil to continue going like absolutely parabolic. Absolutely parabolic. So that's a pretty good rundown on what we're expecting from oil. Obviously, we see here on the daily, it does look like it's getting ready to confirm into that bear trend, that downtrend. The big pushback up here and rejection, followed by a new low. Essentially, it's just a matter of time before this flips bearish. Once it does, we'll eventually expect a reversion to the mean, push back up, and then we'll have to see how the market reacts around like 95 when we get back to it. Again, I would expect a rejection and lower lows. So on to the Dow. Obviously, everyone got a little excited today. It was nice to see a big green candle after so much downward pressure, but not surprising at all. We saw essentially these markets come back down and start backtesting key areas. If we go from our peak back here down to our recent low, and then we basically had the 61.8% retracement, we saw some clear areas of support and resistance on the Dow lining up with the 0.5. We also saw some pretty decent interactions as well along the 382, and now this was our pullback to the 236. So we basically came all the way back down to the minimum level of our Fibonacci that should act as support. If we break down from this point, we would expect it to come back down and revisit the lows. If we find support right here, we would start looking at this as essentially a higher low, and then be looking for it to come back up here and put in a higher high, and then potentially start a new bull trend. Now, of course, we had our 1 test, 2 tests, 3 tests on the descending red line. If we turn off our drawing tools real quick, it was also the back test of the 200 exponential and simple, which so far looks like a clear rejection. And then, of course, we had also the breakout of this green resistance right here. Hasn't been clear cut. We did push above it right here. We had an attempt up, and then it came back down. Obviously, this is an older line. It's been much less useful since the breakout here. But the fact that when we came back down to it, we lined up with the 236. We lined up with the descending green support line. And then, obviously, we have our ascending blue support line right here from our two previous lows. So we have quite a bit of confidence at this level. So obviously we were expecting a bounce, some kind of reaction at this level. It's what happens now that we're paying most attention to. So if we come back up here and we take out this high, it's going to look really, really bullish. If we come back up here and put in a lower high, it's going to look really, really bearish. A move back up to a 0.5 would just be a retest of the 200 exponential, rejection, lower high inside this little micro move, and then likely take us all the way back down to the lows. Maybe we don't even get that high. Maybe we just roll over right now. But the fact of the matter is, in order to get bullish on this right now, and it's very important to always define what makes you switch from bearish to bullish or bullish to neutral or whatever the situation is. So for me, the most important thing is holding a higher low right here is very important. Not taking out a key Fibonacci level, the 236, also very important. Getting above the 200 exponentials and simples, very important. Getting above the descending resistance, getting above the previous high right here. So in all actuality, in order to get really bullish on the Dow right now, to actually look at this as a potential that the bull market is, potentially going to resume, the bear market's over, the Fed's going to pivot, whatever your argument, whatever your case is you're trying to build, for me, the bull case doesn't really resume until like 340 or higher. So we'll see if we get there. Obviously, one little daily candle is not that exciting. Could we see this correspond with a move down in the dollar, with a move down in rates? It's possible. The fundamental case right now for the DXY is probably the strongest it's ever been, just with everything going on in Europe and UK, etc. Japan, obviously, not looking so hot. We'll see. Obviously, that's not always going to be the case, but we're definitely seeing some strength in the DXY. So if we're basically saying, okay, in order for our risk on assets, the stock market, cryptos, etc., to try to even have a legit bullish case, we need to see the TNX or whatever we're using as our treasury yield measure, Fed funds rate, whatever. We need to see that stop going up, or at least slow the speed at which it's going up, or not go up anymore. So do we think that's likely to happen? So we have a Fed meeting coming up. The market is pricing in 75 basis points. That will be a technical breakout on the Fed effective funds rate. So it doesn't seem likely to me that TNX is going to roll over and, start going back to the downside if the market is pricing in 75 basis point hike, and anything over 25 basis points is a technical breakout. So for me, that makes it very hard to build a case based on TNX and the inverse relationship between TNX and risk on assets for the Dow to be putting in any kind of higher highs anytime soon. So that doesn't seem likely. And then obviously the DXY case as well, technically putting in new cycle highs, fundamentally everything going on with the currency pairs that it's paired to does not seem likely that we're just going to suddenly roll over and all of a sudden, the bull case for stocks is going to be back on and the bear case for TNX and DXY. So if we see some weakness in either one of those, we could definitely see some more sustained rallies. If we see weakness in both of them, we could potentially see like an actual sticky rally on, these risk on assets. But the truth is, they're very clearly confirming into a bear market, while, the TNX and DXY are very, very clearly in a very, very strong bull market. So am I going to bet against, essentially being bullish on risk on assets when they're clearly in a bear market, while we know that in order for them to rally and have any kind of sustained rally, we need the DXY and TNX to roll over? For me, the easiest thing to do is just say, okay, let's look at the Dow Jones. Is it still very clearly in a bear market? Yep, it's under the 200 exponential on simple, and they're both very, very bearish. So let's look at the TNX. Is this thing still in a bull market? Well, it's still above the 200 exponential on simple. The 8's above the 21's, above the 200 exponentials, above the 200 simple, and we're very close to putting in new cycle highs. This is a very, very strong bull market. So we have a very, very strong bear market in one, a very, very strong bull market in the inverse one, and then here if we look at the DXY, we're putting in cycle highs in a very strong bull market as well. So for me, just to even try to build a strong case for risk on assets right now, having bottomed or potentially putting in a bottom or potentially rallying or revisiting the highs or putting in new all-time highs, seems almost impossible. I mean, of those three things, the actual asset itself and then the two biggest headwinds it has, the dollar, DXY, and TNX rates, if all three of them are telling me something bearish, there's just really nothing there for me to try to get bullish on these assets. Now, when we have one of these bear market rallies, it's nice to capitalize on. It's definitely nice to take some counter trend trades. But the truth is, everything is still pointing very clearly to the downside, in my opinion. Obviously you can make your own calls. You could make a strong argument that when markets roll over or flip from a bear market to a bull market or a bull market to bear market, it's still going to look bearish short term, to which I would totally agree. And honestly, if you wanted to go that route and essentially argue for, the bottom being in for risk on assets, I would 100% fully entertain that argument. I would definitely entertain that argument. The problem is that, I have a clear cut method for determining if we're bullish or bearish, and everything on every time frame is basically pointing to bearish right now. When we look at the Dow Jones on the weekly chart, this was our big chance for a bullish argument, getting back above the 200s, getting the 821 on the weekly to cross back up. But in all reality, this just looks like a textbook bounce off of key support on a, deep retest followed by a lower high. And then the most likely thing to happen, because we failed to cross the 821 back to the upside, is just a retest of the lows. Now, could we come down here to the lows, put in a double bottom, and then rip to the upside? It's definitely possible. But obviously we know we need to see a change in TNX. We need to see a change in DXY, and we need to see some kind of bullish case being built on whatever risk on asset we're looking at. And right now, there is no bullish case. There really isn't. And if we just switch over to the monthly as well, this for me is the biggest red flag. Obviously, we're very, very close to an 821 bear cross. Now, we still have 3 weeks left in this month, so still plenty of time before this monthly ends. A lot can happen in 3 weeks. just to save the cross, all we have to do is get back above like 325. The deeper we are below it, the more aggressive it will cross, or the faster it will cross, etc. But we know obviously that the previous time this was the Rona dump when it crossed down. The time before that when we confirmed the cross was 2008, and the time before that was 2001. So we had a couple close calls right here in like 2015 where we were able to save the trend. It is still very possible that we do that same thing again, but we do know that the 3 times, this goes back to 1998. The 3 times in the last 20 years that we did see a confirmed cross, that cross was followed by, a pretty disgusting, dump. So it was 30% the first time from the cross. In 2008, it was substantially more. It was 48% from the cross. And then obviously from the Rona dump, from the actual cross, it was 29%. So we're looking at, roughly 30 to 50%. So let's just assume the cross takes place right here. We can look at essentially a 30% move down, puts us back at like 220 on the Dow, DIA, Dow Jones. Or obviously, a 50% or so move easily could take us back to our monthly 200s. So it's definitely worth paying attention to, what could happen here, what this is telling us. Now, you could sit here and say, hey, I'm a time traveler from the future, and actually this doesn't happen. This 821 cross doesn't happen. And the bulls save it, and then we go to new all-time highs. And I wouldn't argue with you because you're from the future, obviously. So, assuming that you made a compelling argument that you're actually from the future, and I believed you, I could make a case for that, for sure. Okay, yeah, we just push back up above like 325. We consolidate for like a month or whatever, start to build some strength right here, avert the cross, and then go on to new all-time highs. Sure, that totally, I'm with you. And that would just say, okay, well, the momentum was still pushing to the downside, still pointing to the downside, but, the market found support. And that's why sometimes these lagging indicators and oscillators can bite you in the butt if you don't have a specific strict criteria on how you're going to use them, etc. But the fact of the matter is, when we look at this right here, there's stuff that has to happen before we get bullish. We're already bearish. And what has to happen for us to stay bearish? Well, nothing. Nothing has to happen. If we're still below the 8 and 21 next month, it just looks even more bearish. If we're still, Stokes are still angled to the downside, histograms are still red, slope line is still red, we're still bearish. So in order for us to get bullish, in order for us to start looking more for bullish potential in these markets and start saying the bottom is in, we're not going to new lows, statistically speaking, based on the last, 50 years, every time we had a down, people bust out all these statistics or whatever. Sure, that's great. It works right up until it doesn't, but this works every time. So that's how I'm looking at it. That's what I'm faced with. Basically, the way these markets look, until they do some specific, very clear, very definable things, there's no reason for me to switch and all of a sudden be bullish. So let me jump over and chat real quick. What's going on, Eli? Good to see you. Jay Hoff, cool sheet says, sup, bro? Sweet BART action on Biddy. Yeah, oh yeah, 100%, man. I literally said in the group, I was like, get ready for a $700 candle. Now, obviously, it has underperformed since then. We only got I think it was up to almost $500 for a minute there. Parag says, what's happening, everyone? Crypto trend trader, can we do a Bitcoin deep breakdown at some point in the future like you did the ETH one? Yeah, for sure, man. It was enlightening. Yeah, I'll do one as a static video, definitely. Appreciate the suggestion. Thank you for all the great alpha. Oh, for sure, man. All right, so let's jump back in here. So obviously, that's a pretty clear breakdown on the Dow. We know, obviously, we have the slope line is still blue right here. We're below the 0 line and all red histograms on the daily. So there's definitely still potential for further downside. We are inside the bearish control zone. Stokes are still angled to the downside, but we see the blue Stoke is starting to roll back up here. We see the knife starting to push back up here. So likely what it looks like is going to happen here is we probably chop around, try to push up, and then we see what kind of reaction we get on that. If it rolls over and it fails and we break down from that, there's going to be a strong bear case now, because essentially we'll have lost the key, what was resistance as support in green, and then our support here in blue, and the 236. So going sideways is actually, bad for the blue support. It's okay for the 236 and the descending green support. But if we fall from this area, basically, we really have to look at these lows and say, okay, how bullish is the market really if we sweep the lows? And to tell you the truth, what I normally will look for is breadth of the market. On the way up, obviously, we see the breadth getting broader and broader and broader, and people get excited. But, what is that really? It's just people. It's the same thing that happened in Bitcoin. Bitcoin breaks through a key level, bullish or bearish, and then all of a sudden, people use what just happened on Bitcoin, and then they rush into altcoins, and they broaden, they increase the breadth of their quote-unquote investments or speculations in crypto. And then obviously as we start going down, people, typically the behavior in the past has been that you pull away from the risky, investments or altcoins or whatever, and back into like the more stable things like Bitcoin and ETH. Now, obviously that's not what we're seeing lately. We're seeing more and more that, and obviously the speculative mania is still not in full effect, but it's still in effect. We're seeing more and more people are, just betting heavy on, whatever random like shitcoin or crypto or whatever. So that also tells me that the likelihood that we're putting in a bottom when everybody's still like bottom feeding for like the most trashy cryptos and stocks on earth, it's very, very low in my opinion. Obviously you're entitled to your own. So next we have the SPY. SPY has a very similar setup right here. It's slightly, found support slightly before the 236. So a little bit more bullish, basically, a little less technical. We have the same levels to the upside, the 200 exponential and simple. We saw the clear resistance at the 0.5 and 618. Obviously this was a super easy trade. It was very easy to figure out exactly what was going to happen here based on the weekly 200 exponential and simple and then the daily 200 exponential and simple. If you were literally just trading those, you pick the bottom perfectly and then you pick the top perfectly. That's pretty damn easy and pretty damn effective. Why people overcomplicate everything, I will never understand. I think a lot of times people get focused on some new thing or something exciting or something that worked or something they just heard about and try to get that extra edge. And the truth is, in my opinion, you find a couple things that work and just perfect that edge, and you're going to be substantially better off than somebody that knows how to use 100 indicators kinda versus somebody that knows how to use 3 indicators like beautifully. I mean, if you see this same posture of a bull trend rolling into a bear trend or a bear trend rolling into a bull trend, you see it enough times and all you see is what's already like happened a million other times on a million other charts. And then you can see more clearly, okay, this is probably what's going to happen. Could it fail? Of course. But, based on enough charts, you start getting pretty damn comfortable with what you see happening. And, obviously you see that reflected in the analysis we do on the regular. So on the SPY right now, we basically got rejected off resistance. We're finding support at support levels. We have very clear lower low that we don't want to take out right here. But, again, very, very difficult for me to try to build any actual bullish case when the chart's not building a bullish case. Like if my job is to defend this chart and make it look good, and then the chart just comes to me and says, hey, I'm actually the killer. How am I going to defend you? You just told me you're the killer. Like I can't be your lawyer. In this specific example. So what is SPY? I had all the chance in the world to get bullish right here. Of course, we sell into resistance because we expect a rejection. It gets rejected. Likely we come back down here to the lows. Somewhere around like that 365 level. We see a rejection off the slope line, a rejection off the zero line, multiple red histograms. We see the Stochs still trending to the upside from that move right here, but starting to, potentially lose momentum, roll over. We'll obviously see what happens there. And then again, the most important is at this point in time, we have to respect what's going on in the monthly. Again, the bulls have to do something for us not to be even more bearish. Because obviously if the 821 crosses the downside, that's really, really bearish. And we saw that again in 2008 and 2000. We didn't even see it take place on the SPY for the Rona dump because, it V'd so fast. So if it happens right here, as we're with the Dow, it was a 1 in 4. There was 3 specific examples where that had happened. That would have been the 4th potential example, what we're looking at. Here we have only 2. We didn't even get the 3rd one here. So, that's a 3rd example potentially. So it's really bad. Obviously this was a bad situation right here, but fiscal and monetary policy, was able to get us out pretty quick. 2000 and 2008 were long, drawn out, and very, very painful. Lots of people lost everything. Some people lost everything both times. Some people never got back, after 2008, or some people never recovered from 2000. So at this point in time, I don't have to build a case for why we need to respect the potential cross. Now, again, there have been instances where it looked like we were going to cross and then we didn't. But, I mean, it's impossible for us to build any kind of bull case without respecting the potential bear case. So we're not going to go quite as deep on the Qs or IWM. NASDAQ and Russell. So NASDAQ, basically, again, same thing. Everything looks essentially the same on all of these. I think you have a little clearer of a picture on the Dow Jones and the S&P, but still worth paying attention to. Again, this was 2000 bubble burst. This was 2008. And then again, we see the cross has already taken place here. And again, we didn't even have that cross on the Rona dump. So, you know, again, we have two specific examples where it happened. This was bad, obviously, and didn't even have the cross. So the fact that we've already crossed right here tells us it's probably going to be worse than this, and more likely it's going to compare to one of these two here. Now, we're also pretty far away from the 200s. So do we get down like another 50% on the NASDAQ? I mean, this chart is implying on the monthly that, yes, actually, that's probably what's going to happen. You know, and that would be a back test of a 200 exponential and simple. So again, we don't want to get overly bearish now, you know, but we were pretty damn bearish the whole way down. And then we got pretty damn bullish at the bottom, talking about all the confluence. And then, of course, our take profits were at resistance. So the best thing to do right now is we're kind of in the middle of resistance and support right now. You know, we don't want to necessarily bet on direction right this second. If it comes back down to support, maybe we want to buy support if we're bullish for a pushback up here. If it, you know, comes back up to resistance right now, maybe we want to sell into resistance, you know, for a pushback down to the lows. We'll buy support, sell resistance until we make up our minds on the actual direction. And we know, obviously, that would be either a lower low or a higher high. But the last thing I want to do is I don't want to just flip a coin right here in the middle of no man's land between the 200 exponential and simple. Well, you guys know, obviously, we took quite a bit of profits on crypto and still short some stocks as well, tech. But we'll see what happens right here. But I'm not necessarily looking to like open new positions in the middle of what amounts to like, you know, a coin toss. Now, obviously, we still have a little bit of bearish bias below the 200 exponential and simple. But, you know, we're down at levels where we could see like an actual bounce. So we had a pretty aggressive bounce for a few weeks straight right here. And then we had a pretty aggressive sell-off after that. Not crazy to think we got another bounce coming back up, you know, another 3 to 5% that lasts a couple more weeks. Not crazy to think that we have a little bit more bullishness, you know, coming up with our, you know, all of our data that we're waiting on. Basically, we have everything jammed into like the next 2-week period. The big things obviously being, you know, CPI data, obviously paying attention to inflation, and then obviously how the Federal Reserve reacts. And, you know, well, I mean, assuming, I say potential, but assuming we're going to get rate hikes. And then for the Russell, same thing, back testing 200 exponential and simple, all looking pretty much the same here. Let's skip over to the monthly. We'll see on the monthly, we already had the cross down. The Russell did have a cross in 2020, 2019, did have a cross here in 2015, and then also 2008 and 2000 as well. So the Russell's a little quicker to show weakness, which makes sense. That's what's going on right now. But after this pretty aggressive rejection right here, it seems more likely than not we're headed back down to new lows. And obviously it took us one candle to get from where we're at, you know, one way or the other. So it's not crazy to think that we're only one monthly candle away from new lows. Could it be this month? Is it going to be next month? Probably. All right, so that's our major indexes. I want to pay attention to SMH, semiconductors, obviously one of our key areas to look out for. We do see, again, some pretty strong weakness in the semiconductor space. We got clear rejection off the 200 exponential. Didn't even get up to the 200 simple. And at this point in time, you know, threatening the lows pretty aggressively here. We see that some of what were leaders like NVIDIA are already putting in new lows. Really, there's quite a bit of tech actually putting in new lows. How are we doing on time? 44 minutes. So we want to keep these relatively short. I'm not going to go into... Yeah, we'll talk about... all right, we'll talk about our CPI data a little closer to the day. I do want to just mention this really quick. Obviously, tons and tons of people have been talking about like the Fed data lately, and everyone is talking about, you know, essentially the Fed balance sheet. This was going into 2019, obviously after everything going on, and then Fed starts cutting rates, balance sheet starts going up. This is the pandemic right here. Obviously, confirm into recession. Fed balance sheet starts going to the moon. Fed stops, aggressive buying right here, and then just slowly keeps buying consistently mortgage-backed securities and treasuries. So now everybody is saying the Fed's lying. They're not actually selling. They lied to us. They broke our hearts. They can't be trusted. Sure, okay. I get why people are confused. This whole ramp up essentially towards like the quantitative tightening took place over like a 3-month period essentially. And then the actual purchases that take place from the Fed or expirations happen in like 2-week increments. So like the middle of the month and the end of the month. So if they say they're going to start doing something or reach the maximum by this month, and then there's a 2-week delay, and then sometimes there's a 1-month delay, and then you have various things running off. It's not like the Fed is literally saying on the first of the month, we're selling $95 billion worth of, mortgage-backed securities and treasuries. It's not how it works. They say, okay, this month our target is 95 billion. So we're going to see what's going to run off on its own. We're going to make some purchases based on those numbers. And then at the end of the month, we want to see 95 billion less on our balance sheet. So obviously we've been working up to that. The overall peak was middle of April 13th, makes sense, obviously. And then from that, obviously these are reported on Wednesdays. From that level, we were at 9 trillion basically. 8 trillion 965 billion 487. So then what happens is, stuff runs off. The Fed replenishes some of those or makes purchases still, and then other stuff runs off, and then the Fed makes more purchases, and then more runs off, and over time the balance sheet gets smaller. So here we have, basically 9 trillion, 8 trillion 965 billion. And here, as of August 31st, 2022, and this will be updated, should have been updated today, actually. So they may just be a little slow on the update. So we should get a new update here. Matter of fact, let me see if... All right, so now we're at 8 trillion. Yeah, no, it didn't get updated. But we're at 8 trillion 826 billion. So if we look from the peak right here, 8 trillion 965 billion, and here we're at 8 trillion 826 billion. We have basically sold off roughly $40 billion. So, let it run off. We didn't sell off anything. But that's $140 billion from mid-April to the end of August. So we're talking about, roughly like 4 months. 3 of those months, we were still ramping up towards our target of 95 billion per month. And even then, that's just a target from the Fed. They have talked about potentially selling in the future, but this is just letting things run off. Now we can look at the breakdown between mortgage-backed securities and treasuries, and maybe we'll do that like in a stream to come later on. But the idea of people saying that the Fed's not actually doing any QT or whatever, it's complete idiocracy, idiocy, whatever you want to call it. They clearly are. Now, does it look crazy huge when we go from 9 trillion to 8 trillion 850 billion? No, it's not going to look massive when we look at, the lifetime of this chart. No, it does not look like much right here. But that's 150 billion. That's a lot of money. That's a lot of liquidity sucked up. That's a big deal. If you don't think 850 billion is a big deal and you're like, well, it's out of 9 trillion though. Sure, but it's still 850 billion. Before this took place in March of 2020, the balance sheet was at 4 trillion 241 billion. So sure, I don't just expect them to all of a sudden drop 4 trillion off of this. Even the Fed themselves will tell you their goal is to do this over, I think it was like 3 to 5 year period or something like that, to get back down towards like 4 trillion. So, if this is what's happened on their balance sheet, and we see what's happened in the economy and in the stock market and everything like that, if you don't see how important this little bump and this little amount is already, I mean, imagine what 4 trillion less is going to look like. I mean, assuming we ever got there, which obviously we're probably never going to have a $4 trillion balance sheet again. But this is a big damn deal. $150 billion is a lot of money. And it doesn't seem like it because we've all been desensitized. But I promise you, this is a big deal, what's happening right now. And it's only just begun. This is going to start accelerating to the downside, you know, because now this is the August 31st data. By the end of September, we would expect this to be down to like 8 trillion, 700 and, well, really less than that. Or no, 95, sorry. 95 billion for next month. So it would be 8 trillion, 731 billion. I mean, it's a big deal. You know, I get what people are saying. They're like, oh, it's a drop in the bucket. Sure, because the bucket's really, really big, but it's not just a drop. And then this is another one nobody's talking about, obviously. Very important. We've talked about it quite a bit in the past here. The velocity of M2 money stock. And, you know, obviously this is how many times inside the economy we see like money turning over. This is very, very important. Obviously, we peaked out back here in 1997. And that was at 2.19 times. And we just like completely cratered. We got down to a low here with the Rona dump of 1.1. Very, very low, obviously. But here we saw an initial bounce up and then come back down, and we put in a higher low right here. And now here we are basically threatening that same level again. That 1.1, 49 right here. We're at 1.148. So, you know, something important is going to happen right here. So obviously, if we top out and this starts to roll back over and money velocity goes down, that's really bad. Because it basically tells you like people are trying to hang on to everything they can. And when they do spend money, you know, it's not getting recirculated within the economy. Now, part of that obviously has to do with our massive trade deficits because the dollar is so strong right now. It, you know, incentivizes us to buy foreign goods because we get more goods for less money because the dollar is so strong. So, you know, that's obviously not calculated inside of GDP because we're buying someone else's stuff. So it goes on their GDP, not ours. So, you know, if we start making things more in America, sure, maybe this goes back up some. You know, if we start having behavioral changes, sure, maybe it goes back up some. But we're at key areas right now. If we break above, and it's important to note too, this is updated every quarter. So it's not like you need to watch this like on a daily level. So this is Q2 of 2022. So when we get the Q3 number for this, if it's above this level, that's actually a good thing. That's like a really good thing. It tells you, okay, there's some confidence. People are spending some money. It's recirculating inside the economy. That's good. As we see, you know, potentially like monetary constriction on the money supply, part of that constriction can be made up for with velocity of the money stock. So we have less money in supply, but that money's getting spent more times internally, so it can make up for that gap to some degree. So one thing people don't consider is, you know, the velocity of money in relation to the money supply. Because here we saw, you know, this was a big deal right here. Nobody ever talks about this, of course, probably because they don't understand it. But we saw a massive decrease, you know, basically fell off a cliff right here in Q1 of 2020. We went from 1.376 down to 1.1. And that was obviously as we were already falling. So that was already likely to happen. Now, at the same point in time, we also saw, you know, fiscal and monetary policy like we've never seen before. And, you know, the whole, oh, the U.S. has created 40% more currency in supply in the last 2 years. How are we not going to have hyperinflation? Sure. And then you look at every other country and some did it worse and some did it less and, you know, whatever. But regardless, part of that increase in the money supply is counteracted by the lack of velocity because the money's not getting spent. Like, what is it? If I give everybody $1 trillion, okay, let's just say I'm the Federal Reserve. And I'm like, oh man, we need a more prosperous world. So I'm just going to give everybody $1 trillion. Like if everybody gets $1 trillion in their bank account and they're like, I don't know, this is super shady. I don't really trust the Fed. So I'm not going to touch this money. I'm not going to spend any of it. And I just leave it sitting there. Does that do anything? Does that actually do anything? Everybody's rich now. Everybody has $1 trillion. It's not going to cause inflation because nobody's spending that money. Right? I mean, if nobody ever touches it, Who cares? There could be as much money as you want. If nobody's spending any of it, it doesn't affect the economy at all. It just gives you a larger circulating supply of money that no one's spending. What if the opposite happens? What if I give everybody $1 trillion and suddenly everybody starts spending their money as fast as possible? There's no additional goods or services, so the prices of everything goes up. So obviously that's the complete opposite scenario. That causes massive amounts of inflation. So everything that's done in between, has some varying effect of that. But the fact of the matter is it all ends up being tied back to the velocity. Because if I'm feeling confident in the future, in my job, my ability to earn, my ability to, prosper going forward, if I'm confident, when I get $1, I'm more likely to turn around and spend that dollar. If I'm kind of confident, maybe I save 1 out of every 2 that I get, or 1 out of every 5 or whatever. If I'm not confident at all, I'm super frugal. Every dollar I get, I kind of hunker down and I just say, well, I better hang on to this one. So the idea that the psychology and the actual money velocity is just as important to the whole scope of things as the total circulating supply is very important. Very, very important. Because here's the truth. If we didn't have velocity fall off a cliff right here, we would be in a massively much more inflationary environment. Because everybody would be spending all that crazy money and the velocity would be going insane. And part of that could be if the dollar wasn't as strong, we'd be buying our own domestic goods instead of importing goods. Part of that could be, psychology. If everybody was like, oh, everything's fine now, we're just going to go out and keep spending. But what about the opposite scenario? What if we didn't have velocity? We said, what if we didn't have velocity fell off a cliff and we printed all that money? What if velocity fell off a cliff and we didn't print all that money? If we didn't add all that money in? Because all that money did basically it pumped up a lot of like asset prices, housing, obviously, stock market, cryptos. But that's not necessarily what caused the sticky inflation. And had the opposite happened, had we not printed all that money and then this fell off a cliff, we would be in a depression right now. You can't have money velocity like go down this much and then all of a sudden not have any money in the system and then eventually like just expect things to level back out. So I'm not defending the Federal Reserve or the governments around the world and all their crazy fiscal policy or monetary policy, but it's important to understand that these two things are massive factors. If the velocity is super low and doesn't pick up, let's say the velocity rolls back over and just continues to level out and die, then we know for sure the Federal Reserve will not be able to continue doing what they're doing because there's just not going to be any liquidity. There's not going to be any movement in money and it's going to be super bad. And that's part of the problem with what happened with the mortgage-backed securities, with essentially the Fed propping up the housing market, and now everybody has refinanced at super low rates. We've created this artificial rates, and now what it's going to cause is stagnation in the housing community. Because if you're locked in at a 3% mortgage rate, you don't care. You're not going to sell your house to go get a new house with a 6% mortgage rate, because you could get a better deal on the house and your payment would still be more. You could buy a cheaper house and your payment would still be more or the same. So that essentially has caused stagnation in the housing, community or whatever. So it's very important to understand not only just one specific chart or one specific data point, but how they all relate to each other as well. All right, so let's take a look and we'll do some more deep dives on that stuff and the relationship and everything into the future. But I just want to touch on those things because it's something, again, I haven't heard anybody talking about any amount recently, and they're both very, very important. The same way we've been talking about bond yields and how important, the Fed funds rate and all the yields and everything are right now for a technical breakout. Same with the strength in the dollar. It's just as important to pay attention to a technical breakout in the velocity of money. Because if we break to the upside and velocity starts picking back up, we could see sustained inflation going into the future for like literally decades. We could really see, 60s, 70s, 80s all over again playing out. If velocity rolls back over, it's more likely than not, the Fed's not going to be able to have a smooth, soft landing. And, we'll probably end up pivoting at some point in time. Now, again, I'm not bullish on a pivot right now, obviously. All right, so DXY at highs, still very, very strong on all time frames. We're seeing a hard sell signal here. We're still inside the bullish control zone. Couple red histograms at cycle highs. We don't want to get like overly bearish right here. Bearish engulfing candle, it's worth paying attention to. Hard sell inside of the bullish control zone, worth paying attention to. If we continue down from here, we're probably going to be retesting the previous high right here, or likely retesting the 21. but I would expect somewhere around like 108 to hold. I'm not going to sit here and try to call the top. Everybody that's been trying to call the top on the dollar has just gotten destroyed. So Apple still playing out nicely. We back tested the 200 simple, rolled over below that, below the right at the 200 exponential right now. Obviously, Apple had its event today, so we got the short setup still in full effect. It's like 17% downside from the entry. We are basically right at about what, 9%? Yeah, right around like 8%, 9%. Still looking for that downside target right here. Still looking for a potential deeper pullback. We'll definitely take some profits off the table along the way though. Yeah, as of now, looks like it could have a bounce back up here and give back some. It would make sense potentially to lock in some gains, especially if the market starts to look bullish, but hanging tight for now. Apple obviously looking much stronger than most. So Tesla, again, lost a 200 exponential and simple. Pretty ready to confirm into the bear market here. We are seeing a little bounce here. Not crazy to think we get back up to like 300. I do think this goes lower. We have a series of lower highs and lower lows. This looks like just a pretty textbook descending broadening wedge. And while I do expect a little bit of strength short term here, as we're at some pretty low levels, it does look like we're getting ready to put in new lows on Tesla. Now, I don't know if when we get down here, we're going to put in new cycle lows here. We'll have to see when we get there. I still think we do, but right now, you know, Tesla's more bullish than most things, so we don't want to get overly bearish on it. So Microsoft looking pretty rough here. Obviously had a nice little retest, breaking down, threatening the lows already. Still a little ways to go here, but likely we do put in new lows. Again, starting to show a little bit of strength for a bounce. Google essentially coming down to the lows once again here. Again, looks very, very weak. Just now confirming into a bear market. Nothing really looking good here. Nvidia at new lows. So it was not shy at all about putting in new cycle lows. Very clearly, confirmed into the bear market. We saw pretty pathetic activity out of Nvidia around this area and a weak push up here. And since then, it has been extremely, extremely weak. Part of that obviously has to do with gaming and sort of like the shift taking place right now. Part of it also has to do with crypto and mining rigs, all that good stuff. Obviously, Nvidia's got quite a few video cards that are popular for crypto mining. Obviously, we'll see some kind of shift as Ethereum goes to, proof of stake and people won't need, video cards for mining Ethereum anymore. Obviously, as Bitcoin price continues to fall or we see weakness in the market, we see more miners with, this is the worst case scenario for Bitcoin right now if you're a miner. You went through this long period where the prices for all your equipment are super expensive and you have to wait forever to get them. So you finally get all your equipment in, get your miners on, and then in the meantime, Bitcoin price goes from 70,000 to, sub 20,000. So now you're getting way less when you do mine. And then on top of that, energy prices worldwide are literally going through the roof. In many cases, they're up 10, 20, 50%. If depending what country you're living in or what kind of energy, they might be up 10 times. So if you're a Bitcoin miner right now, or a crypto miner in general, you're in a rough spot. And again, I think that's being reflected in Nvidia's price. I do expect further downside. We had talked about this level, essentially, the initial push up right there. So now when we come back down and take out that level, we have two choices. Are we going to take the same trade setup over again and try to do, capitalize on a lower high? Are we expecting this to go much, much lower? And then we're going to re-enter at a lower. Oh, I thought we had another trade setup in there. I guess not. Re-enter at this lower level when we get back down to it at like the 0.5. Obviously we have to see how the price action develops before we can decide that. So if we bounce this 886, I'm not confident we don't go lower. Obviously at this point in time, coming down to the 382, pretty important level. We front ran it slightly on the way down here, but now, there's no denying, obviously, we have hit the macro 382, and more likely than not, I would expect a reaction from this level. The question is, was this just a front run reaction right here? And so now we're not going to get that same reaction that we would normally be waiting for? Or was this just a bounce off the 786 and now we're still going to bounce the 382? We obviously don't know, so we'll look for some signs from the market. If we can stay above this 138 level and start to roll back over and show some signs of short-term, support or momentum starting to build back up, I'll probably just take the same trade setup again. And instead of taking it all the way back up to the 0.5, we'll take just a slightly tighter setup back to like the 618 right here. So it'd be a little less favorable of a setup, but a nice setup nonetheless. So we'll keep an eye on that. Obviously, you guys know I'm pretty bullish on NVIDIA. The fact that we did break down from this long-term support line is definitely a big deal. You could argue that I could draw it like slightly different. I think if we put it something more like that, and it basically was like a breakdown here, and then this was a back test, I think that's viable. I'm not sure that it makes a difference one way or the other right now, so I'm just going to leave it how I had it. Also, it looks like when we dropped that level, we saw quite a bit of weakness. So is it possible we actually bounce here, come all the way back up, and basically like double top off that descending what was support as resistance? I think there's a pretty high probability of that. So we'll see what happens here if we want to re-enter at the 382 for a counter trend trade, or if we want to wait for the 0.5 and then obviously play it by ear from there. But definitely going to be some potential, especially on like, if let's say for instance the rest of the market doesn't put in new lows, NVIDIA likely overperforms once the market flips back bullish. Let's say it does, everything starts to roll over. NVIDIA probably overperforms the downside because it was weak first. So there's definitely a strong case to be trading, some of the better names of profitable companies that are desirable to own, whether we're in a bull market or a bear market. So Amazon next. So we came back down. We filled that gap. No surprise there. We're finding some support right now. This was basically our W breakout. We got a nice measure move push up here. We're back testing support. If we lose this area as support, I'd likely come back down to the bottom of the range, $100. If this area holds, we probably push back up here to the highs again. Most important thing is getting above the 200 exponential and simple, taking out this previous high here, and then we can start looking at that one. Don't want to get overly bullish right now, but this is technically like constructive in nature, at least compared to a lot of stuff. Speaking of things that are not constructive in nature, here we have Meta. Obviously, this thing is just completely melting down at the lows again. This looks, much more similar to what? Like gold, to Bitcoin. Like we can start to see a lot of these things. How pathetic is it that Meta looks like trash and also its daily chart looks like Bitcoin's? Like that's absolutely pathetic. I mean, this is one of the worst performing stocks in the entire market, hanging out at the lows right here. And this chart looks the most like Bitcoin probably. Well, a lot like Bitcoin. I mean, that is absolutely pathetic. Absolutely pathetic. Oh, biddy. What does it come to? Twitter next. So it's all a little pump up here. Still below the 200 exponential and simple. We talked about a potential bullish case on Twitter. As far as I'm concerned right now, this is basically just squeezing into a triangle. We know there's a limited amount of time left on this triangle. I'm looking at a potential move back down to the bottom of the range at like $36, and then a potential for a scalp up to like 50. If we don't get down to 36, I'm not going to enter. If we just break out and start ripping to 50, I'm not going to enter. It has to be literally the perfect trade. Come down here, give me exactly what I want, the perfect entry, and then I'll potentially take the scalp. Just because this is such a trash stock, and there's just so much of this is just going to be based on news. And the last thing I want to do is position myself in a situation against Elon Musk when he's the master of like tweet influencing to get his way. So like at any point in time, he could come out and just tweet something mean about Twitter and like crash the stock. So I don't want to be on the receiving end of that. So it's got to literally be perfect. So let's take a look at our cryptos. So we have Bitcoin. Obviously, you guys, if you are watching right now, make sure to smash up that like button, subscribe, all that good stuff. And just a reminder, this is not financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly. So Bitcoin futures chart, it's pretty much the same as our spot chart at this point in time. Very, very similar. Came down here, got the double bottom. There's two ways to look at this. Bullish, that we came down to support, and, we're going to buy support. So potential move back up to resistance, 24K. Or you say, okay, we got a pretty weak bounce off of this to a lower high, and now we're retesting it again. So the weaker the bounce, the more likely we are to just fall off the table for that bloody waterfall. Now, there's definitely some signs on the chart, on the indicator oscillators, that we could see another pushback up here to the upside. It's important to note that, and again, I'm not trying to be like mean or anything or hurt anybody's feelings or like talk bad about like your cryptos or anything. But let's just remember, this right here is what people just got excited about. this is the push up here. The few $100 push. The big green bull candle. I mean, this is it. That 3.5%. At the low. We're at the lows. We're there. We literally just put in a new lower low for the whole cycle. The last time we were here, was back in 2020 on the way up. None of this is good. This isn't good. I mean, it looks at me like this is just, we talk about it all the time. You drop the bouncing ball, it bounces, it bounces, it bounces. Each time it bounces just a little bit less, and then eventually it rolls off the stairs. The bloody waterfall, whatever you want to call it. That's what it looks like we're setting up for. I honestly don't know how this chart could look any worse right now. That's the truth about it. So here's our spot market daily chart. So we didn't come down to the wick lows, which is good. Again, we were bouncing that key support. It's important to pay attention that we did actually come down, lower low on our closes. So we have technically just put in a new lower low. So days without lower lows, 0. Days without incident, whatever, we're back to 0. So we did it for a while. We had a few months of not lower lows, and now here we are putting in lower lows. So for me, we're in a bear trend, putting in lower lows, and the lowest low of the entire cycle right now. The last thing I'm going to do is just start getting bullish on it. Now, doesn't mean there's not scalp opportunities, doesn't mean there's not potential, whatever. But the fact of the matter is, Bitcoin did nothing for so many days in a row that this was exciting. And now after that, people are excited about this. But in the grand scope of things, like the difference from all-time high between where we were down 73%, 72.79%, and now we're only down 71.99%. So in the grand scheme of things, not much to get bullish about right now. It's not much to get bullish about. And, we know, obviously, how beautifully the key area, we talked about these key areas to watch and why they were so important and everything. But the most important thing, just switching over to the 4-hour chart real quick, we talked about this. Until we saw the 4-hour chart get a bull cross, which this whole way down, we almost got a bull cross, we almost got a bull cross, we almost got a bull cross. Every time we got rejected really badly by the bears. Every time the bulls put a big old candle in, the bears just completely smacked it down right after. And then this was, basically just like, okay, we give up. And then this is just the back test. So we just broke down from key support. We're back testing that support. If we can't gain some momentum, if we can't consolidate back inside this range at like 20K, this is just basically a back test before we exit. A bunch of people got caught in their positions. People that matter, not like, just random people. Talking about like actual whales, market makers, etc. Got caught in this position right here. So they move the price back up to that level. They exit at break even, get back out, and then price continues to the downside. At least that's what I'm looking at. Now, is there a case that could be made, for a pushback up to like 20K, 22K, 23K? There definitely is. But the 821 has to cross to the upside on the 4-hour before we can even get bullish. And we're now so far away from that, we basically have to get above like 22K just to even start building a bullish case again. So very difficult for me to get bullish at these levels. Very, very difficult. The weekly, this looks terrible. We basically bounced the lows, back test, rejected off the 200 exponential and simple, rejected off the 8 and 21, and we're down here at the weekly lows again. Obviously, we still have a few days before the weekly lows, before the weekly close, obviously. But we just saw a new daily close. Last thing we want to see is new weekly closes as well. At this point in time, we're knocking on the door. This is 3 weeks in a row, basically at or, wicking below the close. It seems pretty probable we're going to go lower here. If this was going to put in a higher low, it would look okay. But this is basically the same low or potentially lower low. Probably just continuation that just hasn't happened yet, in my opinion. You guys know this is a very, very key area on the weekly, going back to 2017. The next key area, if we break down from here, is essentially the wick high and then our like consolidation lows right here, right around like 14K. So that's what I'm paying attention to. That's what I'm still looking at. And, realistically, that's probably where we're headed. And then when we look at the monthly, again, just looks terrible. The 821 have crossed the downside. We're hanging out at the lows again. We're technically lower than if the monthly just closed right now, which we still have 3 weeks left, so it's not even close. You know, we would be closing a new lower low. And again, that's 3 months again where we either opened or closed at the lows. It seems, you know, more probable than not to me that we're headed down to test this level. That's our monthly close right here and open. That's our wick in the same spot again, and that's 14K. So we see a lot of stuff really, really pointing us to 14K. So we'll see what happens. I just, right now, there's just nothing bullish about these charts. You know, and sure, there's some scalps we could make along the way, but I mean, these, you could argue, are like nice scalps that you can make a little money off of. There's no real scalps like in a bear market on the daily, below the 200 exponential and simple, while the 8 and 21 are bearish. Like, there was no bull scalps along the way here. There was no bull scalps along the way here. There's no bull scalps along the way here. Here, there's a decent bull scalp with the 821. Like, if you're going to use counter trend trading on, you know, let's say the daily or something like that, at least have something like the 821 bull cross to use, some kind of tool, not just be like, hey, I'm going to buy the dip because we're at the lows again. Some kind of strategy. I mean, obviously you can do whatever you want. So Ethereum on the daily here. So we came all the way back up to 200 exponential and simple, fell down a little bit. We're very close to crossing the 821 back bullish. That's obviously a good sign. We see the difference between Ethereum and Bitcoin. Ethereum had a beautiful run back up here, much more like stocks, and then a downward consolidation, but still very, very close to the highs. Well off the lows. I mean, Bitcoin is down here revisiting the lows. You know, if Bitcoin was doing the same thing as Ethereum, or rather if Ethereum was doing the same thing as Bitcoin, Ethereum would be at roughly like $1,000 right now. Instead, it's at $1,600. So it's substantially higher, obviously because of the fundamentals, you know, because of technicals, whatever you want, a combination of the both. Doesn't matter. Right now, if Bitcoin looked like this, I would say there's probably a decent probability we backtest the 200 exponential and simple and threaten these highs right here. But with Bitcoin looking as terrible as it does, and the clock ticking on Ethereum, hard for me to get bullish, even though Ethereum chart, you know, arguably could justify it. So here's the two main setups that we've been talking about, obviously, for Ethereum and what could be taking place. So we have our max peak right here. We have the 1 down, the 2 up. We have the 3 down, and now this is our 4 back test. If we go higher on this 4, then, you know, basically that 2367 level, you know, that invalidates our 5 waves down. Also, we have inside of what's taking place now, the potential for a 5-wave structure building right here, where we just put in the bottom of the 4, and we're looking for a 5th wave up right here. So there's definitely still potential for that. Both could happen. We could easily see a pushback up here, top out at around 2400, rolls over, and then we see continuation to the downside. But if we do close above that level on the daily, that's when we start saying, okay, actually we probably are building, you know, a new impulse 5-wave structure, followed by, you know, a pullback, hold support above the 200 exponential and simple, come back up, threaten the top of the 2, and then realistically it was probably an A, a B, a C down, and then, you know, it's not going to develop the way we thought. But, you know, that's why we have best and worst case scenarios. That's why we have these potential, you know, targets for the trade setup. So let's say where we're at right now, we were looking for a trade setup on Ethereum. We held support, as we discussed, 30% upside potential, which would be just slightly higher than when we went up to, a backtest of that key fib, and 11% downside, 2.5 to 1 risk reward ratio, not ideal. Let's say we got the maximum move up here, 57%, same stop loss about 12%. That's like 5 to 1 risk reward ratio. More likely than not, if we get up here, we probably get something in the middle. So we probably get something close to like 3.5, 4 risk reward ratio. So at this point in time, you know, this one doesn't look too bad. Obviously, strong resistance above our head with the 200 exponential and simple. So could be a likely get rejected from here, underperform, also with the clock ticking. But it wouldn't be crazy to think that we're just going to pop up here and get like a nice 20 to 30% move. I think the key level to watch is, do we hold this 1622 level? If we hold this level, we likely to start creeping up here. And if we build any kind of momentum, we probably get 1 or 2 big candles and we're there on the daily. If this just consolidates, rolls back over, it's going to look just like a rejection. And obviously losing this ascending support in yellow tells us, okay, that's probably it actually. And we're going down for the red 5, not up for the blue 5. So this is definitely the decision point that we're at right now. I wouldn't fault anybody for trying to take a bullish trade right now, nor would I fault them for taking, the bearish trade right now. I think it's important though to focus not only on Ethereum, but also what the rest of crypto is doing, or at least what Bitcoin and the stock market are doing. All right, so total crypto market cap, back down here at the 200 simple. It is technically putting in a higher low for now, which is good. It's more bullish than Bitcoin, which is good. But what does that tell you? It tells you that people are bullish on alts right now, like while the markets look terrible. That's basically just a setup for people to get wrecked, in my opinion. So we have the Bitcoin dominance chart putting in new lows right here on Bitcoin dominance. Again, telling us that people are in more altcoins. And then also we have, so like 3 lows right here. We have that special Bitcoin dominance chart without the stable coins. And here we see we're putting in a higher low right here. So it tells us that actually this tells us realistically that without the stable coins taken into effect, that people are not like that bullish right now on altcoins. That a lot of what looks like bullishness on altcoins is actually people moving into stable coins, because the stable coins, including the altcoins, are making up a larger portion of the market cap because we're at new lows. So Bitcoin dominance is at the lowest it's been this whole entire cycle down, if you include stable coins. But if you don't include those stable coins, Bitcoin dominance is actually a lot higher than it was back here in May, or here in September, or here in January. So that gives me a little faith in how stupid crypto people are. A tiny bit. I mean, not much at all. But it helps just a little bit. It helps just a little itty bitty bit. So we see Matic is next. Again, one of the stronger ones, consolidating at the 200 exponential on simple. It was crossed back to the upside. It did lose that cross. Looks like it wants to roll over, starting to lose some momentum. This thing could definitely fall out of bed at any point in time. I would be real cautious on some of these ones that perform well. Here we have BNB. Started to roll over and then actually had a pretty aggressive pushback up. That looks to me like just a back test of this channel right here. We talked about the 2 potential scenarios. One would be if this channel held for a long right here. And then I said, actually, the one that I'd be looking at would be the short. So basically, if we lost this channel breaking down, which obviously happened, and then it came back essentially to the entry point. But in all reality, even if you're just looking at the short back down to the neckline at like 213, that's like $70 to the downside. But realistically, I'm looking at the macro 382, and we're talking about like $114. So we're looking at 60% downside. Arguably with like a 20% stop loss, you could run a much tighter stop loss, obviously. Or once a trade does move in your favor, move the stop at least to break even. But realistically, very clearly bearish trend. Looks like it's getting ready to break back down to that level. And when it does get down to like that 200 level, it's going to be in some big trouble if it decides to let go. Like 130 and then, $40 basically are a target. So could get real nasty for BNB. All right, and then we'll go ahead and wrap it up with a couple of these bad boys. So we have the gold chart. Been through this a million times. It is hanging out at the lows at the bottom of the channel. The longer it spends hanging out at these levels, the worse it is. Likely going to break down from here. But in the meantime, it is holding up. It is trying to build some bullish divergence right here. So the key is basically, does it push back up to 1800 or does it break down out of the channel? Probably pushes up short term. Silver put in a new low, hit the Fibonacci perfectly, had a little bounce off of it, back testing that previous low from right here. Again, same type of thing, building some bullish divergence, trying to get a move up. Probably moves back up to like $20 or $21. There could definitely be a trade here on silver for a scalp. Gold silver ratio, putting in new highs, seeing a little pullback, back testing the previous high right here, the previous high right here. So if that holds its support, silver's probably doing worse than gold, and gold is going to continue strengthening relative. So GSG, The commodity index fund. So breaking down below the 200 exponential and simple, we talked about 200 simple is about to cross the upside. We're retesting the lows. We got a new low close, lower than any other daily close right here. The majority of the time, when we do come back down to the 200 exponential and simple, even if we penetrate it, we at least will backtest somewhere to put in a lower high. So there could be a trade setup from here. You could argue that this was our bounce, and now actually we're getting rejected and going lower. I could see either one playing out. I think commodities right now and some energy are looking much more weak than others. I think you need to be a little more selective in the short to medium term. FCG, First Trust Natural Gas ETF. Again, we see the difference between something like nat gas versus something like oil. Nat gas obviously much stronger. Oil already breaking down to like new lows. So definitely a reason to be diversifying right now. Energy still looks okay. It does look like we're about to get some short to medium term downtrend action or like downward pressure. So you're looking at uranium, speaking of energy and everything. Again, CCJ holding up real nicely. I did take some profits up here, obviously, as I let you guys know. We'll see what happens. We do still have a lower high for right now. We're right around the 786. The wick up was to the 886. So, pretty technical still. If we do start consolidating back above this level and pushing up, there's definitely a possibility I will be re-entering. But we are at some pretty high levels. Definitely seeing a little bit of exhaustion. Definitely seeing like a little bit of like speculative fervor and everything in these markets. I think we're probably topping out right here still. URA, Global X Uranium ETF, clearly lower highs and clearly lower lows. Much less of a bullish picture being painted right here. Quadruple U's, same thing, lower highs and lower lows. Technically I have like a double top right here, but pushing back up, trying to reclaim the 200 exponential and simple. Again, likely going to see a little more downside pressure. And then UROI painting a much more bearish picture. Very clear resistance, very clear support. And it looks like we're headed back down to the bottom of the range. Again, we'll see what happens. Uranium trying to hang on for now. It's in a weird spot right now because it's, somewhere in between a commodity and an energy, somewhere in between loved and hated, somewhere in between, the newest fad and also, a cyclical like bull run. We'll see. Still very bullish on it long term, but I think we probably get a better entry. If that changes, you guys will be the first to know. CGC, so looking at our pot stocks here. So CGC, again, broke down below the 821. This thing's been a very, very long downtrend. Last thing we want to do is be holding this. Obviously took profits on this one. Looking to re-enter again for another scalp sometime in the future. Tilray breaking down to the lows, likely headed to new lows. Very, very weak. We have talked about this scenario for quite some time. This is actually like what I'm waiting for. So we're very close to the all-time lows for Tilray at 247, and it's literally like 2 daily candles, and we're at a clear support right here. And if we break down any lower, that's probably where we're going. I would absolutely love if Tilray broke down to a new low and everybody that ever bought this stock was underwater in it, and that to me would be a very nice buying opportunity, because typically you see maximum pain, maximum capitulation right towards like the end. Now, I'm not saying that these are going to bottom out anytime soon. We could be looking at a 1, 3, 5 year bottoming process before these even start moving back up. But it's hard to argue that there's not some value in these cannabis stocks. ACV looking pretty weak as well. 821 cross back to downside, threatening the lows. This to me is like a ticking time bomb. September 20th earnings. This thing has been brutalized with its earnings. Going back to obviously February of 2020, November of 2019, it had positive earnings, and then it had 1 positive earnings since then, and the move it got afterwards was so bad. Even if it does get like a beat, what's that really going to do? It's going to have like a 5% move or something? I don't know. This thing's pretty beat up. But hey, that really should tell you, when cannabis stocks really start going down, that's how you know, hey, wait a minute, this market might be actually like out of sellers, at least the cannabis portion. Sundial, again, just getting wrecked right here, threatening the lows already, likely goes to new lows. Hexo, again, wrecked, threatening the lows, likely goes to new lows. Got to be real careful in these pot stocks, getting overly bullish too soon. I'm confident that like 5-10 years from now, anything you bought in the pot stock space in the last like year is probably going to be in massive profits, but it could be a painful couple years before then. So we don't want to get too ahead of the game trying to scoop up value when the value just might not be there. So but yeah, that's it. We're going to go ahead and wrap it up there. Hopefully everybody enjoyed the stream. Obviously touched on a little bit of everything. Got a pretty clear outlook ahead. Pretty good idea what we need to see to start looking for bullish setups. And then obviously key levels for bearish setups as well. And then, some clear invalidation and take profit zones for our opening trades already in play. And obviously we'll be back on Friday for our stream at 11 a.m. till roughly 1 or 2 p.m. And then, of course, every week our streams from Wednesday and Sunday from 8 p.m. till roughly 10 p.m. But yeah, we'll go ahead and wrap it up there. As always, this is not financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly. We'll be taking some requests for the next stream on Friday. If anybody has anything in particular they want to look at, make sure to let me know ahead of time or live on stream. But yeah, we'll go ahead and wrap it up there. Good to see you, Eli. Thanks to the velocity of money was money. Yeah, for sure, man. It's very important to pay attention to those things. It's essentially like looking at one side of an argument and then making your decision without hearing the other side, or like a debate. You have two people debating. If you just listen to one person's side of the argument, they're like probably going to make a strong argument and you might even be convinced. And then if you go listen to the other person's side of the argument without taking in the first person, they probably can make a compelling argument as well. But if you don't listen to both sides of that debate or that argument, there's no way that you can fully get like the legit picture. You might listen to those two people independently and say, oh, you're right for sure. Oh, you're right for sure. You put them together and maybe now you don't know who's right, or maybe there's still a clear winner. But if you don't ever hear the other side of the argument, I mean, you're up shit's creek in my opinion. And I think that the two sides of that coin that everybody needs to pay attention to is not just money supply, but velocity. Now, is there some money supply multiple towards velocity that allows you to calculate, exactly what's going to happen in the economy and the stock market and what? I mean, there's some ways that you can measure things. There's definitely a relationship between the two. But as far as I'm concerned, there's not like a crazy specific exact like formula you could look at. But if we look at this chart and we look at what's going on here, if we see the dip was from, depending where you're going to measure from, obviously, let's just say 1.5 because it's just a nice round number. So if you go down from 1.5 velocity of money down to 1.1, you basically had what amounts to, a roughly like 33% decrease in your velocity of money, or 30%, let's just say. So if velocity of money went down by 30% and then, money supply went up by whatever they're saying, 40%, is that really that crazy? Like, sure, I mean, if one went down by 30 and the other went up by 40, then there's like that 10% gap, which is like 30% of the move. So maybe that's what accounts for, the difference in what we saw in like asset prices, whether it's homes or stocks or crypto, etc. And it was that difference. So maybe if they only printed 30% more money instead of 40% more money, maybe everything just kind of goes sideways and we see a couple things shoot to the upside, but in all actuality, it's more balanced. So arguably, if the opposite happens, obviously the Fed right now is tightening up the money supply, and we're seeing like the money supply going down because they're removing liquidity from the system, and other central banks obviously are doing so as well. Actual banks are doing less lending. So we're seeing a contraction taking place for sure. So what we need to see now, in order for any kind of like a sustained move in one direction or the other, we need to see what the velocity does as well. Because if velocity moves up and makes up for some of that difference, maybe the economy actually doesn't have to get that bad. And it can just be like pain in the stock markets and, the pain that we've seen obviously with inflation and whatnot. But if velocity starts going up aggressively, it's less painful. If velocity starts rolling back over as they're decreasing the money supply though, which could happen, we're obviously at resistance right here. If all of a sudden this rolls over and starts headed back to the downside, that's the scenario where we see serious pain, because you have velocity contracting while money supply is contracting. And the reason we were able to avoid so much pain right here is, as velocity was already falling off a cliff. Keep in mind what we're talking about here. This is Q1 2020. Velocity is already accelerating to the downside. It's already getting bad. and then falls off the cliff in Q2 as all that other money is coming into the system, and then look at the recovery we get. Pathetic. So if we get rejected right here and this rolls over as the Fed is tightening and taking liquidity out of the system, that's when we could be in real trouble, because this big move down here was it was counteracted by the Fed and, the government, obviously the Treasury. If we see a move down here and we don't see, a move up, we could be in real trouble. Could be in real trouble. That's when you get the real stagnating economy. That's when you get the real, stagflation, or, real recession, or real bear market, or real, depression, whatever, is when you have those things working in unison. And then you start taking into account some of the other factors as well, like the DXY and TNX. And you say, okay, let's just say worst case scenario, the Fed continues to tighten, velocity rolls over and continues to slow. And, that basically says, okay, the whole world is probably going into a pretty bad recession, arguably, depression. And then you say, well, how is that going to look in comparison when we look at United States? And then we look at the treasuries and we look at the DXY and we say, okay, actually, treasury yields are high, which means that even if everything's going down, we're likely going to see more inflows to the United States than to other countries, because people are going to chase that yield. So if we're offering higher, yields and more security, AAA bonds, obviously like treasury, high demand, lots of liquidity, all that good stuff, money flows into that. So that will help the United States to actually stay strong while other countries are weakening. Ones with, lesser rates, less desirable bonds, etc. And then the same thing with the DXY. If we see yields are strengthening, we see the dollar is strengthening, that would essentially give us the same thing, telling us, hey, if we're going to be investing money, or our current investments, we want them likely to be denominated in dollars or United States investments. Otherwise, we could end up getting counteracted good decisions by bad decisions. Like if we bet on, the UK stock market, and the UK stock market goes up 20%, and then meanwhile, the British pound goes down 20% compared to the dollar. When I go to sell that stock back into dollars, we're up 20%, we're down 20%. I'm basically even. Now it's slightly different, obviously, but that's not desirable to me. So, that could be a different scenario if you're in the UK. Obviously, let's say the United States stock market outperforms the UK and you live in Britain, all your bills and everything are denominated. And then also the British pound, gets killed compared to the dollar. That's a double win, because now you're invested in, the American stock market while it's going up stronger than the British stock market. And then on top of that, you're benefiting from your currency getting weaker while the dollar gets stronger. Well, your gains are going to be denominated in dollars. So you get the 20% you made off the move up. And then you get also the arb between, the currency, like foreign currency, like exchange rate. So in all actuality, you can like double benefit, or you can double, double take the pain essentially by that. So it's important to look at all the different things, how they relate to each other, and then try to build a thesis, tell what's going to change the current thesis, what is the current situation. And I think right now the easiest thing to look at is the Fed is focused not on employment, they're focused on inflation. And we know for sure over the last year or so that as long as the DXY is strong, as long as the TNX or Fed funds rate is strong or rising, that it's going to be very difficult for asset markets to rally, with the exception of, potentially like energy. So that tells us, hey, as long as the DXY and TNX are strong, as long as inflation is still the top thing, no reason to start looking for a bottom or calling for a bottom or expecting a bottom. That's just my opinion though, obviously. So we'll go ahead and wrap it up there. Appreciate everybody tuning in today. Hopefully you guys enjoyed the stream. I will do a deep dive on Bitcoin, a new fresh static video sometime in the probably sometime this week, and look out for that, and we'll have some other statics as well. But that is it for today. Obviously none of this financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly. It is 9:40 p.m. Eastern Standard Time on September 7th 2022. I am of course a crypto trend trader, and I am out of here. Peace, y'all.